Before we begin, a quick and important disclaimer. I am not a licensed financial advisor or insurance agent. This presentation is for informational and educational purposes only, and is based on publicly available information and my own analysis as of late 2024. Insurance rates and policy details can vary dramatically based on your personal circumstances, location, and the specific agent you work with. Always consult with a qualified professional and read your policy documents carefully before making any financial decisions. Let me tell you about a driver we'll call Mark. For over a decade, Mark was the perfect customer for Allstate. He paid his premium on time every single month. He had a clean driving record. He even bundled his home and auto insurance, believing he was getting the best deal and the best protection. He truly believed he was in good hands. Then came the phone call that changes everything. A distracted driver ran a red light and T-boned his car with his daughter in the passenger seat. Thankfully, everyone was okay, just shaken up. But his car, the one he relied on to get to work, was totaled. This was the moment of truth. This was the exact reason he'd paid thousands upon thousands of dollars over the years. He filed the claim, expecting the smooth, reassuring process he'd seen in the commercials. What he got instead was a bureaucratic nightmare. Lowball offers, delayed communication, and a feeling that the company he'd been so loyal to was now treating him like an adversary. Mark's story isn't unique, and it raises the single most important question you can ask about your car insurance. When the worst day of your life happens, will your insurance company have your back? Or will they have you fighting for every last penny? You see, the big secret of the insurance industry is that the slick commercials and friendly slogans mean absolutely nothing until you have to file a claim. And for millions of Americans, the company they trust with their financial security is Allstate. It's one of the largest, most recognizable brands in the country. But in 2025, does that brand recognition actually translate to good value and great service? Or are you just paying a premium for a famous name and a catchy jingle? That is exactly what we are going to find out. Over the next few minutes, we are going to pull back the curtain on Allstate Auto Insurance. This isn't going to be a surface-level review. We are going deep. We will dissect their pricing structure and show you who they're cheapest for, and who is likely overpaying by hundreds of dollars a year. We will break down every single coverage option they offer, from the standard liability to the special add-ons you've probably never heard of, and tell you which ones are actually worth your money. Most importantly, we're going to analyze their claim satisfaction and customer service record, using real-world data and customer feedback to answer that critical question. What happens when you actually need them? My promise to you is this. By the end of this video, you will know more about Allstate than 99% of their own customers. You will have a crystal clear understanding of their strengths, their weaknesses, and you will be able to decide with total confidence if Allstate is the right choice to protect you and your family in 2025. So let's start with the big picture. Who is Allstate? They are a titan of the industry. Founded in 1931 as part of Sears, Roebuck & Company, they are now a massive, publicly traded corporation with a network of over 12,000 exclusive agents across the United States. This is their core business model, and it's the first thing you need to understand. Unlike companies like Geico or Progressive that primarily sell directly to you online or over the phone, Allstate's Main Street presence is built around local agents. This can be a huge advantage or a significant disadvantage, depending on what you're looking for. The upside? You get a local, dedicated professional who can give you personalized advice, answer your questions, and help you navigate the complexities of your policy. For people who want a human connection and expert guidance, this is a massive selling point. The downside? That agent's office, their staff, and their commission are all built into the price of your premium. This structure often means Allstate isn't the rock-bottom cheapest option on the market. Their entire brand is built on the idea of being a premium service provider, not a discount insurer. The question we have to answer is whether the service and peace of mind they promise actually justifies that potentially higher cost. To figure that out, we have to start with the product itself, the insurance policy. Let's break down the coverage. When you get a quote from Allstate, you're going to see a lot of terms, and it's crucial you know what they mean. First, you have your liability coverage. This is the one that's legally required in almost every state. It's not for you, it's for the other guy. It pays for their medical bills, lost wages, and property damage if you cause an accident. Allstate will show this as two numbers for bodily injury, like 25/50ths, which means they'll pay up to $25,000 per person and $50,000 total per accident. Then there's a third number for property damage. A word of warning. The state minimum requirements are dangerously low. If you cause a serious accident, those minimums will be exhausted in a heartbeat, and you'll be on the hook personally for the rest. We'll talk about how much you really need later on. Next up are the coverages that protect your car. This is where collision and comprehensive come in. Collision is exactly what it sounds like. It pays to repair or replace your car if you hit another vehicle, a tree, a pole, whatever. It doesn't matter who is at fault. Comprehensive, or comp, covers almost everything else. Think of it as acts of God and idiots. A tree falls on your car, a hailstorm turns your roof into a dimpled mess, a deer jumps out in front of you, your car is stolen, or it's vandalized. That's all covered by comprehensive. For any car that you can't afford to just walk away from and replace with cash, you absolutely need both collision and comprehensive. Then you have uninsured and underinsured motorist coverage. Do not skip this. I repeat, do not skip this. National statistics show that as many as 1 in 8 drivers on the road has no insurance at all. If one of them hits you, your liability coverage does nothing. Their insurance does nothing because it doesn't exist. Uninsured motorist coverage steps in and acts like the at-fault driver's insurance, paying for your medical bills and, in some states, your car repairs. Underinsured is similar. It kicks in when the at-fault driver has insurance, but not enough to cover your extensive medical bills. This coverage is your financial shield against irresponsible people. Now that's the standard stuff you'll find with any insurer. Where Allstate tries to differentiate itself is with its optional coverages and special features. This is where the marketing gets slick, so let's cut through the noise. First, you have their famous accident forgiveness. The promise is simple. Your rates won't go up just because of one accident. Sounds great, and it can be, but it's not free. You either have to earn it by being accident-free for a period of time, or you have to pay extra for it as part of their gold or platinum protection plans. Is it worth it? If you have a household with teen drivers, it might be a smart bet. If you have a spotless record, you might be paying for a feature you'll never use. Another big one is new car replacement. If your new car is totaled within the first 2 model years, Allstate won't just give you the depreciated actual cash value. They'll give you enough money to buy a brand new car of the same make and model. This can be a lifesaver, as new cars lose thousands in value the second you drive them off the lot. If you have a new car with a big car loan, this coverage is almost a necessity to avoid being upside down after a total loss. They also offer rental reimbursement, which is a must-have. If your car is in the shop after a covered claim, this pays for a rental car so your life isn't thrown into chaos. It's inexpensive and provides incredible value. Finally, they offer things like roadside assistance and even coverage for custom equipment or sound systems. These are the building blocks of an Allstate policy. But how do all these pieces fit together when it comes to the price you actually pay? That's where we dive into the murky world of discounts. And this is where the real game is played. Discounts aren't just a friendly little bonus Allstate throws your way. They are the single most powerful tool you have to slash your premium, sometimes by half or even more. Think of your base rate as the sticker price on a car, and the discounts are the negotiation. Most people only know about 1 or 2, but Allstate has a whole playbook, and today I'm giving you a copy. Mastering these discounts is the difference between an affordable policy and one that makes you wince every month. Let's break this down into 3 core categories. Discounts for who you are as a driver, discounts for how you manage your policy, and discounts for what you drive. First up, the big one, discounts for you, the driver. This is all about rewarding good behavior. The most obvious is the Safe Driver discount. This isn't just a vague pat on the back. It's a tangible reward for having a clean driving record. No accidents, no violations. The longer you maintain that clean slate, the more valuable this discount becomes. It's Allstate's way of betting on a sure thing, and you are the sure thing. But the real heavyweight champion in this category, the one that causes the most debate and offers the biggest potential savings, is DriveWise. You've probably heard of it. It's Allstate's telematics program. You either use a small device you plug into your car or just an app on your phone, and it monitors your driving habits. Now I know what you're thinking. Big Brother is watching me drive. And you're not entirely wrong. It tracks things like your speed, how hard you brake, the time of day you drive, and your total mileage. Here's the deal. Allstate claims you can save up to 40% with DriveWise. 40%. That is a massive, game-changing number. Just for signing up, they usually give you an initial discount. Then, every 6 months, they analyze your driving data and adjust your performance discount. If you're a fantastic driver, Smooth acceleration, gentle braking, avoiding late-night trips. You could see your premium plummet. But there's a catch, and it's a big one. In most states, bad driving can now increase your premium. This is a critical change from how these programs used to work. It's no longer just a carrot, there's a stick too. If you're constantly slamming on the brakes in city traffic, or you work a night shift and do most of your driving after midnight, DriveWise could actually work against you. So, you have to be brutally honest with yourself. Are you the calm, cool, and collected driver you think you are? Or are you a little more spirited? My advice is to try it. The initial discount is usually guaranteed, and you can see your own driving data in the app. If after a few weeks you see a score that makes you nervous, you can opt out. But for safe, predictable drivers, leaving the DriveWise 40% on the table is like refusing free money. Beyond that, there are other driver-based discounts you need to hunt for. Are you a student? If you're under 25 and maintain AB average or a 3.0 GPA, you qualify for the Good Student discount. You literally get rewarded for good grades. If you have a student away at college more than 100 miles from home without a car, you can get a student away from home discount. Don't just assume Allstate knows this, you have to tell them. And for older drivers, typically over 55, completing an approved defensive driving course can unlock another discount. It's a few hours of your time for years of savings. It's a no-brainer. Okay, that's you. Now let's talk about the second category. Discounts for how you manage your policy. These are the easiest ones to get because they have nothing to do with your driving and everything to do with being an organized customer. The king of this category is the multi-policy discount, also known as bundling. This is the one every single insurance agent will push, and for good reason. If you have your auto insurance with Allstate, and you also bundle your home, renters, or condo insurance with them, they will give you a significant discount on both policies. Why? Because it makes you a stickier customer. You're less likely to shop around and leave if you have to move 2 or 3 policies instead of just one. It's a win for them, but it's a huge win for you. If you have renter's insurance with another company, or you don't have it at all, which is a huge risk in itself, get a quote from Allstate. The savings on your auto policy alone might be more than the entire cost of the renter's policy. Next are the simple, set it and forget it discounts. The Easy Pay Plan discount. All this requires is setting up automatic payments from your bank account. That's it. You save money because Allstate doesn't have to worry about a missed payment or a check getting lost in the mail. Alongside this is the eSmart discount. Go paperless. Get your documents via email instead of snail mail. It saves them printing and postage, and they pass a small part of that savings on to you. You should be doing these 2 things anyway. It takes 5 minutes to set up and saves you money forever. Then there's the responsible payer discount. If you didn't have any late payments or cancellations in the previous policy term, they reward you. It's a loyalty perk for being reliable. And if you have the cash, the full pay discount is a big one. Paying your entire 6-month or 1-year premium upfront saves Allstate a ton in administrative costs, and they give you a nice chunk of that back. If you can afford to do it, you absolutely should. Finally, in this category, there's the early signing discount. This is one people almost always miss. If you get a quote and sign your new policy at least 7 days before your old policy with another company expires, Allstate will give you a discount. They are rewarding you for being proactive and not waiting until the last minute. It's the easiest money you'll ever make. That brings us to our third and final category. Discounts for the car itself. The specific vehicle you drive has a huge impact on your rate. First, the new car discount. If your car is the current model year or the previous model year, and you're the first owner, you get a discount. The logic is that newer cars are generally safer, have more advanced safety features, and are less likely to have hidden mechanical issues. And speaking of safety features, Allstate rewards you for them. Anti-lock brakes? That's a discount. An anti-theft device like a passive alarm system or a tracking service like OnStar? That's another discount. Passive restraint systems, that's just a fancy term for the factory-installed airbags and motorized seatbelts. Yep, that's a discount too. Most modern cars have these, but you need to make sure they're listed on your policy. Don't assume they know. Verify. So you see, it's not about one discount. It's about stacking. It's about building a fortress of savings around your policy. A good student who drives a new car with an anti-theft system, who bundles their renter's insurance, pays automatically, signed up 10 days early, and uses DriveWise carefully isn't getting one discount. They're getting 7 or 8. They're layering these savings on top of each other until their premium is a fraction of what someone else might pay for the exact same coverage. This is the offensive strategy. This is how you actively lower your bill. But insurance isn't just about offense. You also have to play defense. Because for every discount that can lower your rate, there are a dozen hidden factors that can send it skyrocketing, often without you even realizing why. And some of them are things you'd never ever expect. Things that have nothing to do with driving at all. Let's start with the one that makes people's blood boil. The one that feels the most unfair. Your credit score. So what does your FICO score have to do with your ability to merge onto a highway? In the cold, calculating world of insurance, the answer is everything. Allstate, like nearly every other major insurer, uses a credit-based insurance score to help set your rates in most states. Now, they'll tell you this isn't the same as your regular credit score. It's a special formula, a proprietary blend of your financial history designed to predict one thing: the likelihood you'll file a claim. Think about that for a second. Not the likelihood you'll cause an accident. The likelihood you'll file a claim. To them, the data is undeniable. Decades of actuarial tables show a strong correlation. People with lower credit scores tend to file more claims. Why? The theories vary. Maybe they're less likely to pay for small repairs out of pocket. Maybe the financial stress that leads to a lower credit score also leads to more distracted driving. The insurance companies don't really care about the why. They only care about the correlation. So, that late credit card payment from 2 years ago? That student loan you struggled with after college? To Allstate, that's not just a financial hiccup. It's a red flag. It's a piece of your financial DNA that suggests you are, statistically speaking, a bigger risk. It's a ghost in their machine that can cost you hundreds, even thousands of dollars a year, even if you have a driving record as clean as a freshly detailed car. A 2021 study showed that drivers with poor credit in some states pay over twice as much as someone with excellent credit for the exact same coverage. That's not a small difference. That's the difference between an affordable necessity and a crippling monthly bill. It's a premium penalty based not on how you drive, but on how you manage your money. But it gets even more personal. Let's talk about where you live. Not your state, not even your city. I'm talking about your specific street, your zip code. You and your neighbor across the street could have identical cars, identical driving records, identical credit scores, and you could be paying a different rate. Insurers call this territory rating. They slice up the country into thousands of tiny territories, sometimes just a few square blocks, and assign a risk level to each one. This isn't just about whether you live in a bad neighborhood with high crime rates. It's far more sophisticated than that. They analyze the frequency of accidents in your specific area, the density of traffic on your commute, the number of claims related to vandalism, theft, or even weather events like hail. They even look at the cost of labor and parts at the local auto body shops. If it costs more to fix a bumper in your zip code, you're going to pay more for coverage because their potential payout is higher. So you could move 5 blocks to a new apartment for cheaper rent, only to find your auto insurance premium mysteriously jumped by 20%. You haven't changed. Your driving hasn't changed. But you crossed an invisible line on Allstate's risk map. You've entered a different territory, and you're now paying for the collective driving sins of your new neighbors. You are, quite literally, being judged by the company you keep, or at least the company you park next to at night. And the judgment doesn't stop there. It gets into the most intimate parts of your life. Are you married? Single? Divorced? To an insurer, your relationship status is a critical piece of data. Statistically, married drivers get into fewer accidents and file fewer claims than their single counterparts. The data suggests they are more stable, more cautious, and less likely to be out late at night taking risks. As a result, getting married can often net you a significant discount on your Allstate policy, sometimes as much as 15 or 20%. But let's flip that around. It's not so much a marriage discount as it is a singles penalty. If you're not married, you are, by default, placed in a higher risk category. Your responsible, single friend who's in bed by 10 p.m. every night is paying more than the married couple next door who just bought a souped-up sports car, simply because of a ring on a finger. It has nothing to do with individual behavior and everything to do with which statistical bucket you fall into. And that's the key to understanding all of this. You're not being priced as an individual. You're being priced as a collection of data points, a member of various risk pools. And some of those pools are based on things you would never imagine. Take your job, for instance. Or your level of education. Yes, Allstate and other insurers can use your occupation and how many degrees you have to set your premium. Why on earth would being a teacher make you a better or worse driver than being a construction worker? Again, it's all about correlations. Actuaries have found that people in certain professions like scientists, pilots, and yes, teachers, tend to have lower claim rates. People with higher levels of education, like a master's degree or a PhD, also fall into this lower risk category. The logic is murky. Maybe certain jobs require more attention to detail, which translates to the road. Maybe people in other jobs are on the road more, or in more congested areas. The insurer's reasoning is kept inside an actuarial black box, but the result is clear. Your job title and your diploma can either save you money or cost you money, regardless of your actual performance behind the wheel. An engineer and a bartender with identical driving histories will not get the same quote. One is statistically safer in the eyes of the algorithm, and the other will pay the price for it. So they're judging you on your credit, your address, your love life, and your career. It feels like your actual driving is the last thing they care about. But that's where you'd be wrong. Because even when they are looking at your driving, they're not just looking at tickets and accidents anymore. They're watching you in ways you can't even imagine, thanks to technology you willingly put in your car. And that technology, that little app on your phone, has a dark side that can be used against you in ways that go far beyond a simple discount. Let's call this technology what it is, a black box. Not just in your car, but a black box of data collection, and you are the subject of the experiment. This isn't some far-off dystopian future. This is happening right now on your phone with an app called DriveWise. Allstate markets it as a simple tool for good drivers to save money. You install the app, you let it track your driving, and if you're a safe driver, you get a discount. Sounds like a win-win. But the devil, as always, is in the data. Imagine this scenario. You're driving home late one night, a bit later than usual because you were finishing a project at work. You're on a familiar road, maybe a bit of a winding country lane. You're going the speed limit, 45 miles per hour. Suddenly, a deer leaps out from the trees. You slam on the brakes, your heart pounding in your chest. The car screeches, the ABS kicks in, and you swerve just enough to miss the animal. You come to a hard stop, shaken but safe. You take a deep breath, wait a minute for your hands to stop shaking, and then you accelerate quickly to get back up to speed and get out of that dangerous, unlit spot. You get home, thankful you avoided an accident, and you don't think about it again. Until you do. Because in your pocket, your phone was watching. The Allstate DriveWise app, which you installed to save a few bucks a month, was logging everything. It didn't see a deer. It didn't see the dark road. It didn't feel your adrenaline spike. Here's what it saw: a heartbreaking event. That's strike one. It saw a rapid acceleration event right after. Strike two. And it saw you were driving after 11 p.m., which it flags as late-night driving, a statistically riskier time to be on the road. Strike three. In the space of 30 seconds, your heroic accident-avoiding maneuver was translated by an algorithm into 3 distinct negative data points. 3 strikes against your driving score. Your safety discount for the month? It just vanished. In fact, depending on your state's regulations, your performance in the program could now be used as a justification to increase your premium at your next renewal. You did everything right. You prevented a costly claim for Allstate, and your reward is a penalty. You are being punished for being a defensive driver. This is the fundamental, dangerous flaw of telematics. The algorithm has no eyes. It has no understanding of context. It only has sensors. The accelerometer in your phone feels the G-forces of you braking and accelerating. The GPS tracks your speed and your location. The clock notes the time of day. It even knows when you pick up your phone while the car is in motion, flagging you for distracted driving, even if you're just a passenger in an Uber and forgot to turn the app off. Every trip becomes a data mining operation. Allstate logs the specific times you drive, the routes you take, your average speed, how you take corners, and how often you're on the highway versus city streets. They are building a detailed, intimate profile of your life, one trip at a time. Where you work, where your kids go to school, how often you visit the doctor, the bar you go to on Friday nights. This isn't just about a discount anymore. It's about total surveillance. And here is where it gets truly sinister. Let's go back to our deer scenario. But this time you don't miss. You hit the deer. It's a mess, your front end is smashed, and you have to file a claim. You call Allstate, your trusted insurance provider who you've paid thousands of dollars to over the years. You explain what happened, but they already have their own version of the story, a version written by the machine. They pull up your DriveWise data from the incident. Their claims adjuster might see that you were driving at the maximum speed limit on that road, just seconds before the heartbreaking event. They might argue that a safer driver would have been going slower on a dark, winding road at night. They see the rapid acceleration you did the week before when merging onto a busy highway, and paint a picture of you as an aggressive driver. They can use this data, the data you voluntarily gave them, as leverage. Leverage to argue you were partially at fault. Leverage to lowball your claim settlement. Leverage to make the entire process a nightmare. Think about the legal implications. In the event of a serious accident involving another vehicle, that telematics data can be subpoenaed. It can be used in a court of law. Imagine sitting in a deposition while a lawyer for the other side grills you, holding a printout of your driving data. Mr. Smith, can you explain why on the night of the accident, you braked so hard it registered in the 98th percentile of all braking events recorded by your insurer? Can you explain why you were driving at 11:37 p.m., a time Allstate itself designates as high risk? Can you explain the pattern of rapid acceleration we see here in the weeks leading up to the crash? Your own insurance discount tool has become the prosecution's star witness against you. And Allstate's terms and conditions, that fine print nobody ever reads, gives them the right to use this data for underwriting, for claims processing, and for research. You gave them the rope, and now they can use it to hang you out to dry. And if you think MileWise, their pay-per-mile program, is any better, you're mistaken. It uses the exact same tracking technology, it just bills you differently. You're still providing a second-by-second log of your every move in the car. The risk is identical. You're trading privacy for the potential of a small discount, while the insurer gains a treasure trove of data that gives them an unprecedented advantage over you, their customer. They're not just insuring your car anymore. They are monitoring your behavior. And they are judging you not with human understanding but with cold, unforgiving code. An algorithm that can't tell the difference between a reckless driver and a hero who just saved a deer's life. To the machine, you are not a person, you are a risk score. A collection of data points to be analyzed and, if necessary, used to minimize their own financial liability. But the data they collect from DriveWise and MileWise is just the beginning of the story. It's what they combine this data with that should truly terrify you. Because Allstate isn't just looking at how you drive. They're buying data about every other aspect of your life, from your credit score to your social media posts, to create a deeply invasive psychological profile. And they're using that profile to predict your future, and to decide just how much you're going to pay for it. This isn't science fiction. This is the reality of insurance in 2025. The engine driving this predictive machine is a vast, interconnected web of data brokers, companies you've never heard of like Axiom, Experian, and LexisNexis. These companies exist for one reason: to harvest every scrap of digital information about you and sell it to the highest bidder. And insurance companies like Allstate are their #1 customer. Think about it. Every time you use a store loyalty card, you're not just getting a discount on groceries, you're telling a data broker what you eat, what you drink, what cleaning supplies you use. They know if you're buying baby formula or heart medication. Every time you like a post on social media, you're feeding the algorithm. You like a page for a local car show featuring modified imports? The algorithm flags you as someone interested in speed and high-risk driving behavior. You post a photo from a rock climbing trip? You're an adrenaline junkie, a risk taker. You use a credit card to buy a subscription to a political magazine? You've just revealed your ideological leanings, which algorithms correlate, rightly or wrongly, with certain behavioral patterns. Allstate isn't just buying this data from third parties. They've built their own data-devouring monster. It's a company called Arity. Allstate founded Arity in 2016, and its entire purpose is to collect and analyze movement data. They claim it's the largest data set of its kind, gathered from over 100 million connections, including smartphones and in-car devices. If you've ever used an app that tracks your location for traffic, weather, or rewards, there's a good chance Arity is in the background, collecting your data. They know how fast you drive, how hard you brake, what time of day you're on the road, and the routes you take. They are building a pattern of your life, mile by mile. And they combine this driving data with that mountain of personal data from the brokers. The result is a profile so detailed it would make a Cold War spy blush. Let's call it your risk signature. This signature is not about who you are as a driver. It's about who they predict you will be. Let's play this out. Two people, let's call them Mark and David, live next door to each other. Same age, same car, same clean driving record. Not a single ticket or accident between them. Under the old system, their insurance rates would be nearly identical. But in Allstate's new world, things are very different. Mark is a high school history teacher. He's married, has 2 kids. His credit card statements show purchases at Home Depot and Old Navy. His social media is mostly pictures of his family at the park. He subscribes to a home and garden magazine. His digital footprint screams stable, predictable, cautious. David, on the other hand, is a freelance graphic designer. He's single. His credit card shows late-night food delivery, tickets to concerts, and a subscription to a video game service. He recently posted a picture from a weekend trip to Vegas with his friends. His digital footprint, in the cold, unblinking eye of the algorithm, screams impulsive, unpredictable, higher risk. So, who gets the higher quote from Allstate? David. Every time. Not because he's a bad driver, his record is perfect, but because his lifestyle doesn't fit the narrow, conservative mold of a low-risk individual. He's being penalized for being single, for working non-traditional hours, for having hobbies the algorithm deems risky. His perfect driving record has become secondary to his psychological profile. This brings us to the most controversial tool in their arsenal, the credit-based insurance score. Now, this is crucial. Your insurance score is not the same as your FICO credit score that a bank uses for a mortgage. It's a completely separate secret score. Insurance companies claim this score is highly predictive of whether you'll file a claim. Their logic is that people who are responsible with their finances are also responsible in other areas of their life, including driving. But let's be honest about what this really is. It's a proxy for wealth, a way to charge poorer people more for the exact same product. Think about it. Who is more likely to have a lower credit score? Someone who lost their job, someone buried in medical debt, a young person just starting out with a thin credit file. Are these people inherently worse drivers? Of course not. But the algorithm doesn't care. It sees a lower score and jacks up the premium. It creates a vicious cycle. If you're struggling financially, Allstate makes it even more expensive just to legally drive to work to try and improve your situation. It's a poverty tax, plain and simple, hidden behind a veneer of advanced risk assessment. They will defend this practice with mountains of data and correlation charts, showing that, yes, on average, people with lower scores file more claims. But correlation is not causation. A person working 2 jobs who is forced to drive an older, less reliable car might be more likely to have a breakdown or a minor fender bender. A person who can't afford a $500 deductible out of pocket is more likely to file a claim for a cracked windshield than someone who can just pay for it themselves and not risk a rate hike. The system isn't measuring your risk as a driver. It's measuring your financial fragility and punishing you for it. And the most insidious part? This is all happening in a black box. You can't see your insurance score. You don't know what specific data points are being used against you. Was it the concert tickets? The late-night pizza order? The fact that you applied for a new credit card last year? You have no idea. You just get the bill. A take-it-or-leave-it price calculated by a secret formula, based on a secret profile, that judges every corner of your life. This is the price of admission to Allstate's world in 2025. You're not just buying insurance for your car. You're submitting your entire life for review. And the judgment can be harsh, arbitrary, and profoundly unfair. They have perfected a system for predicting the future. A digital crystal ball built from the breadcrumbs of our daily lives. So they've built this perfect digital prison, where every click and every purchase can be used against you. But what happens when their perfect algorithm gets it wrong? What happens when the machine makes a mistake? And you're the one who has to pay the price. That's when you discover the dark side of automated decision-making, and a customer service nightmare you wouldn't wish on your worst enemy. Let's talk about a driver named Michael. For 2 years, Michael was Allstate's perfect customer. He signed up for DriveWise, plugged the device into his car, and treated it like a game. He aimed for a high score. He accelerated smoothly, braked gently, and never, ever touched his phone while the car was in motion. And it worked. He was saving a solid 15% on his premium. He felt smart, like he'd cracked the code. He was a good driver, and Allstate was rewarding him for it. The system was perfect. Until it wasn't. One Tuesday afternoon, Michael was driving through a residential neighborhood, going 5 miles under the speed limit. Suddenly, a golden retriever, leash trailing behind it, darted into the street right in front of him. Michael slammed on his brakes. The tires screeched, the anti-lock system pulsed under his foot, and his car stopped inches from the dog. His heart was pounding. The dog's owner came running out, apologized profusely, and Michael, shaken but relieved, drove away. He'd done the right thing. He'd saved a life. 2 days later, he got an alert from the DriveWise app. His score for the week had plummeted. The reason? One instance of extreme braking. A single event, lasting less than 3 seconds, had wiped out months of careful driving data. He figured it was an anomaly, a glitch. But then his renewal notice came in the mail. His premium hadn't just gone up, it had skyrocketed by 40%. The discount was gone, and he'd been hit with a massive surcharge on top of it. The algorithm had judged him. It saw the data, a sudden violent stop, and concluded he was a high-risk driver. It had no context. It didn't know about the dog. It didn't know he was a hero. It only knew the numbers. So Michael did what any of us would do. He called customer service. And this is where the real Allstate experience began. The first representative he spoke to was polite but unhelpful. She could see the extreme braking event in the system, but she had no power to change it. She said, "I understand your frustration, sir, but the system calculates the rates automatically based on the data we receive." He asked to speak to a supervisor. After 20 minutes on hold, he was transferred. The supervisor was also polite, also expressed sympathy, and was also completely powerless. "I'm sorry, Mr. Anderson," she said, "but the DriveWise data is what it is. We can't manually override the risk assessment." Michael was furious. He tried to explain. "There was a dog. I had to stop. Are you telling me I should have hit the dog to protect my insurance rate?" The supervisor didn't have an answer. There was no button on her screen for "Driver saves dog's life." There was only the cold, hard data point. He was trapped in a logic loop, arguing with people who were just messengers for a machine. He even called his local Allstate agent the friendly guy who sold him the policy. The agent listened, sympathized, and ultimately said his hands were tied. The underwriting and rate setting was handled by corporate, by the algorithm. He was just the local face of a global machine. This story isn't an isolated incident. It's a perfect illustration of the fundamental challenge you can face with Allstate's customer service in 2025. There's a massive disconnect between the "you're in good hands" marketing and the reality of their scaled, automated, and often impersonal infrastructure. When things are going well, it's fine. But when you have a problem that doesn't fit neatly into a checkbox on their screen, you risk falling into a bureaucratic abyss. Let's look at the official data. 4 years, J.D. Power, one of the most respected consumer ratings agencies, has tracked customer satisfaction across the auto insurance industry. In their 2024 U.S. auto insurance study, Allstate's performance is, well, it's complicated. In some regions, like the central U.S., they score slightly above average. But in critical, high-population regions like California and Florida, they consistently rank below the industry average. Their overall national score often lands them squarely in the middle of the pack. Not terrible, but certainly not great. But here's what a rating like average actually means. It means for every happy customer, there's another customer like Michael, tearing their hair out in frustration. It means that while their app might be slick and their website easy to use, the moment you need a human to apply common sense and solve a real-world problem, you have a 50-50 chance of a good outcome. Nowhere is this more critical than in the claims process. This is the moment of truth. This is the single most important reason you pay your premium every month. You're not paying for a fancy app or a catchy jingle. You're paying for a promise. A promise that if the worst happens, they will be there to make you whole. So, how does Allstate hold up on that promise? Again, the data paints a picture of mediocrity. J.D. Power also has a U.S. auto claim satisfaction study, and historically, Allstate again lands right in the middle. But numbers on a chart don't tell the whole story. Let's dig into the common complaints that surface time and time again in online reviews and forums. 3 themes emerge: delays, lowball offers, and the pressure to use their network of repair shops. Delays are a common tactic. The longer they can hold on to their money, the better it is for their bottom line. You might find it takes days to get a call back from an adjuster. Getting an estimate approved can drag on. Every delay adds stress to an already traumatic situation. Then there's the initial offer. This is particularly true if your car is declared a total loss. The first offer you get from Allstate, or any major insurer for that matter, is almost never their best offer. It's a starting point in a negotiation you probably didn't know you were supposed to have. They will use their own valuation methods, which might not accurately reflect the market value of your car in your specific area. They are counting on you to be too tired, too stressed, and too uninformed to fight back. They are counting on you to accept the first offer and walk away. But the most insidious part of the claims process for many is the Good Hands Repair Network. On the surface, it sounds great. Allstate has a network of pre-approved, certified body shops. If you use one, they say the process is faster, the payments are handled directly, and they'll even guarantee the repairs for as long as you own the car. Sounds like a no-brainer. But you have to ask yourself a critical question. Who is the body shop's real customer? Is it you, the person whose car is broken? Or is it Allstate, the multi-billion-dollar corporation that sends them hundreds of jobs a year? The answer is obvious. This creates a potential conflict of interest. These network shops often have agreements with Allstate that dictate labor rates and, most importantly, the types of parts they can use. To keep costs down for Allstate, a network shop may be heavily encouraged or even required to use aftermarket or reconditioned parts instead of original equipment manufacturer, or OEM, parts. Aftermarket parts are generic copies. They may not fit as well, they may not have the same crumple zones and safety ratings, and they can even void your car's warranty. A fender is not just a fender. An OEM fender from Honda is designed and tested to work with your Honda's entire safety system. A generic copy is not. Using one could compromise the structural integrity of your vehicle in a future accident. You always have the legal right to have your car repaired at the shop of your choice. But the adjuster might make it sound difficult. They might say, well, if you go to your own shop, you'll have to pay out of pocket first and wait for reimbursement. Or, we can't guarantee the work if you don't use a network shop. This is pressure, plain and simple. They are steering you towards the option that saves them the most money, not the one that is necessarily best for you or your vehicle. So you're left with a choice. Go with their preferred shop for convenience, but risk getting lesser quality parts, or fight to go to your own trusted mechanic and prepare for a more complicated, drawn-out claims process. It's a perfect example of the system working exactly as it was designed, to protect Allstate's interests, sometimes at the expense of your own. This is the reality of dealing with your own insurance company when you file a claim. It can be a frustrating adversarial process where you have to fight for what you're owed. But what happens when the situation is reversed? What happens when you're not the customer but the victim? What's it like when you're hit by an Allstate driver, and you have to deal with their claims department not as a client they want to keep, but as a liability they want to minimize as cheaply and as quickly as possible? Well, the answer for thousands of people every year is that it's a nightmare. It's a descent into a bureaucratic labyrinth designed with one purpose: to grind you down. When you're the third-party claimant, you are no longer dealing with the friendly, reassuring neighbor from the commercials. You are dealing with a different entity entirely. You are a line item on a balance sheet, a liability. Your pain, your inconvenience, your financial loss. It's all just a number that a team of professionals is paid to shrink. To understand what happens next, you have to grasp a fundamental, brutal truth. Allstate has zero legal or fiduciary duty to you. None. Their duty is to their paying customer, the person who hit you, and more importantly, to their shareholders. Their goal is not to make you whole. Their goal is to close your claim for the lowest possible dollar amount. And they have a well-honed, systematic process for doing it. It's a strategy so infamous in the legal and insurance world that it has a name: delay, deny, defend. Let's start with delay. The accident happens. It's clear-cut. Their driver ran a stop sign and T-boned you. The police report confirms it. You call the Allstate claims number they gave you, and the waiting begins. First, it's the hold music. Then you're transferred. Then you leave a voicemail for an adjuster who seems to be perpetually in a meeting or out in the field. When you finally get them on the phone, they're polite but vague. We're just beginning our investigation, they'll say. We need to get a recorded statement from our insured. Days turn into a week. You need a rental car. You need your car fixed. You're in pain and need to see a doctor. But Allstate is still investigating. They need a copy of the police report which you send. Then they need you to send it again, because they can't seem to find it. They need photos of your car. They need you to get an estimate from one of their preferred body shops. Each request is a new hoop to jump through, another delay tactic. They know you're without a car. They know you're missing work for doctor's appointments. They know that with every passing day, your frustration and desperation grow. The delay isn't a sign of incompetence. It's a weapon. It's the first step in wearing you down, making you more likely to accept any offer just to make the ordeal stop. After they've exhausted the delays, the process moves to stage 2. Deny. This is where things get truly infuriating. Deny doesn't always mean a flat-out no. More often, it's a denial of the true value of your claim. Starts with your car. Let's say the damage is severe and the car is a total loss. Allstate will use evaluation software, often one called CCC1, to determine what your car was worth 1 second before the crash. And almost universally, that valuation will come in shockingly low. They'll find comparable vehicles for sale 3 states away, at wholesale prices with higher mileage or in worse condition, and use them to justify their lowball offer. They'll tell you your pristine, garage-kept sedan is worth thousands less than you know it is. You're left with an offer that won't even cover the loan on your car, let alone allow you to buy a similar replacement. You're already in the red, and the fight has just begun. But the property damage is just the opening act. The real battle is over your injuries. This is where the denial phase becomes deeply personal and insulting. You have whiplash. Your doctor prescribed physical therapy. You needed an MRI to rule out serious damage. To you, this is your health. To the Allstate adjuster, it's a series of bills to be attacked. They will scrutinize every single line item. They'll use their own nurses or doctors, who have never met you or examined you, to review your files and declare your treatment excessive or unnecessary. They'll argue that you only needed 4 weeks of physical therapy, not the 8 your doctor prescribed. They'll claim that your back pain isn't from the accident, but is a pre-existing condition, even if you've never had a day of back pain in your life. They will take your legitimate pain and reframe it as a fraudulent money grab. They are masters of creating doubt. You'll start to question yourself. Were you really that hurt? Are you being a baby? This is psychological warfare. The goal is to make you feel greedy and unjustified for simply trying to get the medical care you need. Also, they can slash the value of your injury claim. They'll make a final, insultingly low offer. Maybe just enough to cover a portion of your medical bills, with nothing for your pain, your suffering, your lost wages, or your diminished quality of life. And if you refuse to accept that lowball offer, if you stand your ground and say, "This isn't fair," that's when you enter the final, most brutal stage, defend. Allstate will simply say, "Fine. Sue us." They know that for the average person, this is the ultimate threat. It means you now have to find a personal injury attorney. It means you're now entering a formal lawsuit. You, a single individual, against a $50 billion corporation with entire skyscrapers full of lawyers on retainer. It's a David versus Goliath scenario. Except Goliath also owns the quarry that makes the stones. The defense strategy is simple. Drag it out for as long as possible and make it as painful as possible. They will use the legal system itself as a tool of attrition. Their lawyers will file motion after motion. They will schedule depositions and cancel them at the last minute. They will request every medical record you've had since birth, searching for any tiny thing they can use to discredit you. They will force you to answer invasive questions under oath for hours on end. They are betting that you don't have the time, the money, or the emotional fortitude to see it through. They know that years of litigation will wear you down until you are so exhausted, so beaten, that you'll take a settlement that is a fraction of your claim's true worth, just to get your life back. This isn't just speculation or a collection of anecdotes. This strategy was systematically designed and implemented. Back in the mid-1990s, Allstate hired the consulting firm McKinsey & Company to re-engineer its claims process. The resulting strategy, detailed in internal documents that later became public through lawsuits, was referred to by critics as the good hands or boxing gloves approach. For their own customers, it was the good hands. For third-party claimants like you, it was the boxing gloves. The documents laid out a plan to intentionally offer less than what claims were worth, and to fight anyone who didn't accept it in court. The American Association for Justice conducted a massive investigation of the insurance industry, and in 2008, they named Allstate the single worst insurance company in America for consumers, citing its hardball tactics and the delay, deny, defend strategy as the primary reasons. So when you're on the other side of a claim with Allstate, you're not just dealing with a single adjuster. You are up against a carefully constructed, multi-decade, corporate-wide system designed to pay you as little as possible. It's a machine, and you are the grist for the mill. You're left with a wrecked car, mounting medical bills, and a settlement offer that feels like a slap in the face. You feel powerless, trapped, beaten. So what can you actually do? Is there any way to level the playing field against a giant like Allstate? How do you fight back when the entire system is built to make you fail? The answer, it turns out, is yes, but you have to know the rules of their game. And the first rule of their game is this. The moment an accident happens, a clock starts ticking. Not just for you, but for them. Their goal is to resolve your claim for the lowest possible amount in the shortest possible time. Your goal is to get the full and fair compensation you are owed. These two goals are fundamentally in opposition. The entire process is a negotiation, but most people don't realize they're even at the table. They think they're just filling out forms. The first 24 hours after an accident are what I call the golden hour of a claim. What you do here can determine the outcome of your entire case. The first move in the playbook is documentation, but not just taking a few blurry photos of the dent in your door. I'm talking about becoming a forensic investigator for your own life. You need to create a fortress of evidence so undeniable that their algorithms and adjusters have no room to argue. Take pictures of everything. Not just the damage to both cars, but from every conceivable angle. Get wide shots showing the full scene, the intersection, the road signs, the traffic lights. Get close-ups of skid marks, debris on the road, the weather conditions. Is the road wet? Is the sun glaring? Document it. Take a photo of the other driver's license, their insurance card, and their license plate. If there are witnesses, get their name and number, and if they're willing, use your phone to record a 30-second video of them stating what they saw. You are building a time capsule of the moment of impact, and this time capsule is your greatest weapon. The second move, and this is arguably the most critical, is controlling the narrative. When you make that first call to Allstate, you are entering the game. You'll be assigned a claims adjuster. It's their job to be friendly, empathetic, and reassuring. It's also their job to get you to make a recorded statement as quickly as possible. Do not do it. I repeat, do not give a recorded statement in that initial call, or even in the first few days. This is a trap, plain and simple. You'll be in shock, you'll be flustered, you might be on painkillers. They will ask you questions like, "So how are you feeling?" The natural, polite human response is, "I'm okay," or "I'm fine, a little shaken up." That phrase, "I'm fine," has cost claimants millions of dollars. Because when you wake up the next day and can't turn your neck because of severe whiplash, that recording where you said you were fine will be Exhibit A in their case to deny your medical claims. The correct response is polite but firm. "I'm not prepared to give a recorded statement at this time. I'm still processing what happened and I need to seek medical attention." That's it. You are not refusing to cooperate. You are prudently controlling the flow of information until you have all the facts, including a doctor's assessment. Once the initial report is made, the mid-game begins. This is where persistence and process become your shield. Rule number 3. Every single communication must create a paper trail. If an adjuster calls you and makes a promise, like approving a specific body shop or providing a rental car by a certain date, your first action after hanging up the phone should be to send them an email. A simple, one-paragraph email. "Hi, adjuster's name. Just wanted to follow up on our conversation a few minutes ago. I'm writing to confirm my understanding that you have approved the repairs at XYZ Auto, and that a rental car will be arranged for me by this Tuesday. If my understanding is incorrect, please let me know." Why is this so powerful? Because it takes a fleeting, deniable phone conversation and turns it into a documented record. Adjusters handle hundreds of cases. They forget things. They get reassigned. That email is now a permanent part of your claim file. It prevents the classic, "he said, she said" runaround. It makes them accountable. You are building your case piece by piece, email by email. Rule number 4 is to understand their vocabulary. They will use terms designed to sound official and non-negotiable. The most important one is actual cash value, or ACV. If your car is declared a total loss, they will offer you its ACV. This is not what you paid for the car. It's not what it will cost to buy a new one. It's what they say your specific car, with its mileage, condition, and options, was worth 1 second before the crash. And their first offer will almost always be low. They use valuation software that pulls data favorable to them. Your job is not to accept it. Your job is to counter it with your own evidence. Go on AutoTrader, Cars.com, and Craigslist. Find at least 5 vehicles for sale in your area that are the same make, model, year, and have similar mileage and options. Save them as PDFs. This is your counteroffer. You can say, "I appreciate your offer of $10,000, but based on the current market in my zip code, a comparable replacement vehicle costs closer to $13,000. I've attached 5 examples for your review." You've just changed the negotiation from their internal black box number to a real-world, evidence-based discussion. This same principle applies to diminished value, the loss in your car's resale value even after it's been perfectly repaired. Most people don't even know they can make a claim for this, but in many states you can. You have to ask for it and you have to prove it. This brings us to the end game. What happens when you've done everything right, you've documented, you've created a paper trail, you've presented evidence, and they still won't budge? They give you a final take it or leave it lowball offer. This is where most people give up. But this is where you use rule number 5. Know when to call in the professionals. There are 2 levels of escalation. The first is free and surprisingly effective. Your state's Department of Insurance. Every state has one. You can file a formal complaint online for free. You detail the entire situation, attach your evidence, your photos, your emails, your comparable vehicle listings. This complaint doesn't just go into a void. It lands on the desk of a specific person at Allstate, usually a manager, whose job is to resolve regulatory complaints. An official complaint from a state regulator gets their attention in a way 1,000 angry phone calls never will. It creates a file on them with the very people who grant them a license to operate. Often, this is enough to get a claim reevaluated and a much fairer offer put on the table. The second level of escalation is hiring a lawyer. People are often terrified of this. They think it's too expensive or too aggressive. But you have to remember, Allstate has an entire army of lawyers on their side. Their entire business model is based on legal and financial leverage. A good personal injury attorney works on a contingency fee, meaning they only get paid if they win you a settlement. And the moment an attorney sends a letter of representation, your file is immediately taken away from the junior phone adjuster and handed over to a senior, more experienced claims specialist. The entire dynamic of the negotiation changes. You are no longer just a claimant. You are a potential lawsuit. Suddenly, they become much more reasonable. You don't need a lawyer for a simple fender bender. But if you have significant medical bills, if fault is being disputed, or if the settlement offer is insultingly low and they refuse to negotiate in good faith, making that call is not a sign of weakness. It's the ultimate power move. By following these rules, you're not trying to cheat the system. You are simply balancing the scales. You are taking a process designed to be confusing and opaque and making it transparent and accountable. You are turning their playbook against them, using documentation, process, and leverage to ensure you are treated fairly. You now have the playbook to fight back when things go wrong. But what if you could avoid the fight altogether? What if there are hidden levers within Allstate's own system that can save you thousands of dollars before you ever have to file a claim? It turns out their obsession with data can be a double-edged sword. And if you know how, you can make that sword work for you, not against you. That's where we're going next. So how do you turn Allstate's data-driven machine into your own personal ATM? It starts by understanding a fundamental truth. Every single question they ask you, every piece of information you provide, is a data point. It's a cog in a massive algorithm designed to predict one thing: how likely you are to cost them money. Your job isn't to be a perfect person. Your job is to be a person who, on paper, looks like their most profitable customer. The game begins the second you ask for a quote. This is their first look at you, and they are building a digital avatar of you based on what you tell them. And one of the most powerful, yet invisible factors they look at is something you probably aren't even thinking about: your credit-based insurance score. Now, this is not your FICO score. Let me be clear. They're not checking if you can get a mortgage, but they use a proprietary model, pulling data from your credit report, to generate an insurance risk score. The logic, from their perspective, is that there's a statistical correlation between how a person manages their finances and how responsibly they manage their life, including their driving. Is it fair? That's a debate for another day. Is it real? Absolutely. And it can swing your premium by hundreds, even thousands of dollars a year. So, the first hack, the foundational strategy, happens months before you even shop for insurance. You need to polish your credit report. This doesn't mean you need an 800 credit score. It means demonstrating stability. Pay your bills on time every time. Lower your credit card utilization. That's the percentage of your available credit that you're using. A high utilization signals risk to their algorithm. Avoid opening a bunch of new credit accounts right before you apply for insurance. These small, simple acts of financial hygiene tell Allstate's algorithm that you are stable, predictable, and therefore less of a risk. You are gaming the system by simply being responsible. Next, let's talk about your car. You tell them you drive a 2023 Honda Accord. They see far more than that. Your vehicle identification number, the VIN, is a key that unlocks a universe of data for them. They instantly know its safety ratings, the exact anti-theft devices it has, its average repair cost, its likelihood of being stolen in your area, and even its specific claims history. This is where you can be incredibly strategic. Before you even buy a car, you can use this to your advantage. You might be choosing between two similar models. One might have slightly better crash test ratings or a more effective anti-theft system. To you, it's a minor difference. To Allstate's algorithm, it's a significant shift in risk, and it will be reflected in your premium for years to come. The real pro move is to get insurance quotes for the specific cars you're considering before you make a purchase. That $500 difference in purchase price could be dwarfed by a $300 annual difference in your insurance premium. You're using their own data against them to make a smarter financial decision. And then there's the location. Your zip code. This is one of the most frustrating variables because it feels out of your control. You could be the safest driver in the world, but if you live in a zip code with a high rate of auto theft, frequent accidents, or even a higher than average number of lawsuits filed after accidents, your rates will be higher. Allstate isn't insuring you. They're insuring you in your environment. While you probably aren't going to move to save money on car insurance, knowing this is powerful. It explains why your rate might suddenly jump, even if you've done nothing wrong. It could simply be that the risk profile of your neighborhood has changed in their data models. It also highlights the importance of things like having a garage. If you can list your car as garaged instead of street parked in a high-risk area, that's a direct input into their algorithm that can lower your premium. But the most direct way Allstate gathers data, the one where you have the most active control, is through their telematics program DriveWise. This is the double-edged sword sharpened to a razor's edge. They offer you a discount in exchange for monitoring your every move behind the wheel. And I mean every move. Most people think it just tracks speed. That's child's play. DriveWise is monitoring hard braking events, sudden acceleration, the time of day you drive. Late night trips are a huge red flag to them. And the big one in 2025, your phone usage. Their app can detect if you're holding, tapping, or swiping your phone while the car is in motion. This is their holy grail of risk data. So, how do you make this sword work for you? First, you need to treat the initial period of using DriveWise like you're taking your driver's test all over again. The first few weeks are critical as the app calibrates your baseline driving style. So, for those first 30 days, you are the most boring, cautious driver on the planet. Accelerate like there's a carton of eggs on the dashboard. Brake early and gently. Pretend your phone doesn't exist the moment you put the car in drive. Use a phone mount and don't touch it. By establishing a near-perfect baseline, you anchor your potential discount at the highest possible level. After that initial period, you can be a little more human, but you have to remain conscious of the main triggers. Every hard brake isn't just a stop. It's a data point that says you were following too closely or not paying attention. Every late-night run to the store is a data point that says you're driving during higher-risk hours. You have to think like the algorithm. Ask yourself, what would a perfectly safe, low-risk driver do in this situation? And then do that. The ultimate hack with DriveWise, however, might be knowing when to say no. The discount, even for perfect driving, often maxes out around 20 or 25%, and for many it's much lower. If you have a long commute, frequently drive at night, or live in a city where hard braking is unavoidable, the program might actually work against you. A bad DriveWise score won't necessarily raise your rates midterm, but you can bet that data will be used to justify a higher premium at your renewal. Sometimes, the smartest way to win the data game is to refuse to play. Finally, the ultimate strategy for turning their system to your advantage is disloyalty. I know it sounds counterintuitive. They offer longevity discounts. But insurance companies, Allstate included, are notorious for something called price optimization. This is a fancy term for what is essentially a loyalty tax. They use data to predict which customers are least likely to shop around for a new policy. Then, year after year, they slowly, almost imperceptibly, raise the rates on those loyal customers, betting that you won't go through the hassle of switching. Your perfect driving record doesn't matter. Your loyalty doesn't matter. Their algorithm has simply flagged you as a sticky customer. The way you fight this is simple. You become unsticky. Every single year, or at the very least every 2 years, you have to reshop your insurance. Get quotes from Progressive, Geico, State Farm, and others. This does two things. First, it ensures you're actually getting the best price. But second, you can take a competitor's lower quote back to Allstate and ask them to match it. Sometimes they will, sometimes they won't. But it forces their hand. It breaks their price optimization model. You are actively demonstrating that you are not the profitable, complacent customer they predicted you would be. By managing your credit, being strategic about your vehicle, understanding your location's risk, mastering or rejecting telematics, and strategically shopping at renewal, you're no longer a passive passenger. You're taking the wheel. You're feeding their algorithm the exact data it wants to see to classify you as a low-risk, highly desirable customer. You've now learned how to play the game and get the absolute best price possible from Allstate. But this brings us to the final, most important question of all. Once you get that price, is the policy actually worth it? If the worst happens and you need them to come through, will they? Because the cheapest insurance is worthless if it doesn't pay a claim. Now we put it all together: the price, the service, the claims process, to deliver the final verdict on Allstate for 2025. So let's break it down. On one hand, you have a legacy carrier, an absolute giant in the industry with a massive network of agents. This is their core strength. If you want to sit down with a real person, have them explain your declaration page line by line, and have a single point of contact when things go wrong, Allstate is built for you. Their coverage options are robust, almost like an a la carte menu. You want new car replacement? They have it. Accident forgiveness? Check. Rideshare coverage? Absolutely. They offer a comprehensive suite of products that can cover nearly every aspect of your life, from your home to your boat to your life insurance, and the bundling discounts can be substantial. Their digital tools like the mobile app and DriveWise are solid, even if they aren't always leading the pack. But on the other hand, you have the price. Allstate is frequently, and I mean frequently, one of the more expensive options on the market. That premium price is supposed to buy you premium service, but the data is complicated. While J.D. Power gives them decent marks, especially in certain regions, the sheer volume of complaints and the below-average ratings from consumer surveys tell a different story. It suggests a lack of consistency. Your experience with Allstate seems to depend heavily on the quality of your specific agent and the particular claims adjuster you get assigned. It's a roll of the dice. And that claims process, the moment of truth, is where many customers feel the good hands promise starts to feel a bit shaky. The stories of slow responses, lowball offers, and frustrating back and forths are too common to ignore. So, who is Allstate actually for in 2025? First, Allstate is a fantastic option for the bundler. If you're a homeowner, maybe with a couple of cars and ATV in the garage, and you're thinking about life insurance, Allstate is designed to be your one-stop shop. The convenience of a single agent and a single bill, combined with discounts that can be upwards of 25%, can make their high initial price much more competitive. You're not just buying car insurance. You're buying into an ecosystem. Second, it's for the driver who craves a personal relationship. If the idea of navigating an insurance claim through a chatbot or a faceless call center makes you anxious, Allstate's agent model is your safe harbor. A good agent is more than a salesperson. They're an advisor. They can help you tailor your policy, advocate for you during a claim, and conduct annual reviews to make sure your coverage still fits your life. For many people, that peace of mind is worth paying a premium for. And third, it's for the person who wants maximum protection. If you're not just looking for the state minimum liability but want all the bells and whistles, the new car replacement, the vanishing deductible, the robust rental car reimbursement, Allstate has you covered. They excel at building comprehensive, feature-rich policies for those who want to be prepared for anything. Now, who should probably steer clear of Allstate? First and foremost, the budget-conscious shopper. If your number one priority is finding the absolute lowest price, Allstate is unlikely to be your champion. Companies like Geico, Progressive, and a host of smaller direct-to-consumer insurers are built on a low-overhead model that Allstate, with its massive agent network, simply can't compete with on price alone. Second, the digital native who prefers a hands-off experience. If you'd rather do everything yourself online, from getting a quote to filing a claim, the agent-centric model might feel like an unnecessary extra step. While Allstate has an app, their entire structure is built around the agent. If you see that as friction rather than a feature, you'll likely have a better experience with a company like Progressive or Lemonade. And third, drivers with a less-than-perfect record or poor credit. Allstate, like many preferred carriers, can be particularly unforgiving with its rates after an at-fault accident or a DUI. And they weigh credit scores very heavily in the states where it's allowed. If you have a few blemishes on your record, you'll almost certainly find more competitive pricing from non-standard carriers or companies that specialize in higher-risk drivers. Let's circle back to DriveWise for a moment. Should you use it? The potential discount of up to 40% is incredibly enticing. But remember, that's a best-case scenario. Most people see something closer to 10 or 15%. And you have to ask yourself if that savings is worth the privacy trade-off. It's not just tracking your hard braking and acceleration. It's tracking your phone usage, the time of day you drive, and your top speed. If you're a genuinely safe, cautious driver who doesn't mind the surveillance, it can definitely save you some money. But if you're a night owl, have a lead foot, or simply value your privacy, you might want to skip it. The potential for your rates to increase based on this data, while not something they advertise, is a real concern for the future of telematics. So how does Allstate stack up against the other titans of the industry? Let's do a quick-fire comparison. Allstate versus State Farm. This is the classic rivalry. Both are legacy companies with huge agent networks. They are more similar than they are different. State Farm generally has slightly better customer satisfaction scores and is often a little cheaper, but it's very region-dependent. The choice between these two will almost always come down to which company gives you a better quote and which local agent you connect with more. You absolutely must quote both. Allstate versus Progressive. This is old school versus new school. Progressive is a data-driven machine, constantly innovating with tools like the Name Your Price tool and their Snapshot telematics program, which is arguably more established than DriveWise. Progressive's online experience is generally smoother, and they are often significantly cheaper, especially for younger drivers or those with a spotty record. The choice here is clear. Do you want a local agent and a robust, bundled package from Allstate? Or do you want a lower price and a slicker digital experience from Progressive? Allstate versus Geico. This is the ultimate battle of business models. Geico is a direct-to-consumer behemoth. They cut out the agent to save you money, and their entire brand is built on speed, simplicity, and a low price point. Geico is for the person who wants to get a quote and buy a policy in 15 minutes without ever talking to a human. Allstate is the polar opposite. You're paying more for the option of human guidance and a wider array of products. Price is your god, Geico is your temple. If service and options are your priority, Allstate is in the running. So, here is the final verdict on Allstate for 2025. Allstate is not the best car insurance company in America, but it's also not the worst. It's a premium brand that charges a premium price for a service that can be, but isn't always premium. Think of it like this. Allstate is the full-service airline of insurance. You get the option of a travel agent, you can check multiple bags, and you get a wider variety of destinations. But the ticket costs more, and sometimes the flight still gets delayed and your bag still gets lost. Companies like Geico are the budget airline. The ticket is cheap, but everything is extra, and you're on your own if something goes wrong. The Good Hands slogan is more of an aspiration than a guarantee. For millions of customers, Allstate delivers on that promise every year. But for a significant and vocal minority, those hands feel absent when they're needed most. Therefore, you cannot choose Allstate based on its reputation alone. You must do your homework. The single most important piece of advice I can give you is this: get multiple quotes. It is the only way to know if you're getting a fair price. Get a quote from Allstate, especially if you're a homeowner. Get a quote from Progressive. Get a quote from a local independent agent who can shop multiple carriers for you. The 5 minutes it takes could save you $1,000 a year. Allstate is a solid, dependable, but expensive option that is best suited for a specific type of customer who values comprehensive coverage and a personal relationship over the lowest possible price. It is a mandatory carrier to include in your comparison shopping, but it is not an automatic choice. Your mission is to find the company that offers the best intersection of price, coverage, and service for you. And that answer is going to be different for everyone watching this video. Go in with your eyes open, understand the trade-offs you're making, and you will find the right policy for your needs.